Now let's turn toward decisions being made in the long run. Now here, the primary assumption is that we have free entry and exit. That is, there isn't any barrier preventing firms from entering this industry. All it really takes is a certain amount of time for them to get resources together, to do things like build factories or what have you, to get everything lined up to start. Right, so firms are perfectly free to join or to leave this industry as they desire. Now, I would note this is actually one reason that perfect competition or price takers markets are so competitive. Because if things are looking good, it makes perfect sense for there to be lots of competitors entering that marketplace. This then leads to the rule that governs the market in the long run, where if there are economic profits, firms will tend to enter. If there are economic losses, firms will tend to exit as there are better opportunities elsewhere. And if economic profit is exactly zero, then we don't have either. Firms won't enter, firms won't exit, or they'll do so at roughly the same rate. Now this leads to what we call the zero profit condition in the long run. Now to get at this, let's imagine what happens if profit is positive. We've already mentioned that firms are going to enter. But as firms enter, we have an increase in supply. But as supply increases, we know that tends to drive prices down. The thing is more plentiful, that tends to push prices down to convince people to actually buy this excess of supply. But if prices fall, it's much more difficult for us to make profits. On the other hand, if profit is negative, then we're going to tend to have some firms exit, probably not all of them, but at least some will exit, resulting in a decrease in supply, with the result that we have higher prices. The thing has gotten more rare, that tends to push prices up compared to where they would have been, and as a result, we have higher profits. Now we notice something here. If profits are positive, if they're greater than zero, they're going to tend to get pushed down. If profits are negative, that is, they're less than zero, they tend to get pushed up. So there's a tendency for prices to always move closer and closer towards zero. Here remembering we're talking about economic profits, so profits beyond what you'd expect to earn in other industries. So put another way, this would tell us that given enough time, profits across various industries are all going to tend to equalize. We'll make roughly the same rate of profit in any industry, regardless of what that happens to be. Now, if profit is zero, we note in this case there's no entry or exit. As a result, there's no necessary change in supply, no change in prices. This is stability. So this is how we would note that we are in a long-run equilibrium. If profit is equal to zero, then we've hit long-run equilibrium. If profit is not equal to zero, then we're not yet in a long-run equilibrium. New firms are going to enter, or firms are going to exit, leading to changes. It's only once profit is zero that we are in a long-run equilibrium in the price takers or perfectly competitive market. Now here, that brings to mind a very important point, and that's the break-even point. The break-even point, right, is a price at which the best a firm can do is break even. This happens at the minimum average total cost. So we know what the total cost is. The average total cost is just taking the total cost, dividing it by the quantity. So take however much it costs to produce the thing, divide by the number you've got, that's the average total cost that goes into each unit of the good. Now, to get at this break-even point, we can note that profit is equal to revenue minus total cost. Right? Or another way we could put that is profit is equal to price times quantity minus average total cost times quantity. After all, if you take average total cost, multiply by quantity, you just have total cost. Then we can play with the math, and the profit is really equal to the price minus the average total cost per unit multiplied by the number of units you sell. So really, whether or not you make a profit is all dependent on how does your price compare to your average total cost. If your price is greater than your average total cost at any quantity you could possibly produce, right, then profit is a possibility. Now, an important point here is that it doesn't have to be the case that price is above average total cost at all levels of production. All it has to be is that at some point you could possibly produce a quantity such that the price is above the average total cost. I'll show what this looks like graphically in a bit. On the other hand, if your price is less than your average total cost at any possible quantity that you could produce, right, that is, looking at all the various quantities, price is always going to be lower than your average total cost, then losses are totally unavoidable. Right, that is, your profit is going to be negative regardless what quantity you choose. If your price is equal to average total cost at just a single point, then, and at the same time price is less than average total cost at all the other points, then we could avoid losses, right? We could, after all, we could produce the quantity where price and average total cost are equal. But at the same time, you can't actually make a positive profit. Instead, you have a profit of zero. The best you can do is break even. And that's where this idea of minimum average total cost being your break-even point comes in. Because what this suggests is that if price is equal to your minimum average total cost, you can break even if you produce at the right quantity. If you produce any other quantity, you're going to end up taking a loss. This then relates to economies of scale and the size of your firm in the long run. Since we know eventually prices are going to move so that profits are equal to zero, we know that eventually prices are going to fall to that break-even point. That is the minimum of your average total cost. This then, the shape of the average total cost, it ends up as typically U-shaped, giving us three different regions we can see here. Now one region is where there's a drop in average total cost the more we produce. So this is the region that we call economies of scale. We'll talk more about detail later on. Then there's some range, potentially, this doesn't always happen, but sometimes there's a range where we have constant returns to scale. That is where a change in quantity doesn't change the average total cost. In effect, what's happening here is that your total costs are rising in proportion to how much you're producing. Then there may be some range where we have diseconomies of scale. This is where producing more actually increases our average total cost. That is, costs are rising faster than production. With economies of scale, this implies that a larger quantity will give you a lower average total cost, which suggests that in such a market, large firms will be more competitive than small firms. They, after all, have a lower average cost, they could afford possibly to charge less, and they can therefore outcompete any of the smaller firms. Examples where this happens tends to be in manufacturing, or any place we have assembly line kind of efficiencies. So if you see an industry where there are really large firms, and it seems like there are no small firms, odds are good there are a lot of economies of scale in that case. With constant returns to scale, this is a case where larger quantities have an identical average total cost to relatively smaller quantities. As a result, neither small nor large firms will really dominate this industry. So if you have an industry where you see both small firms and large firms side by side, competing against each other with neither of them coming out as the clear dominating winner, then odds are pretty good we have constant returns to scale. One example where this happens is law firms. Right, we see at the same time operating side by side large law firms that employ dozens of attorneys and also individual people that set out their placard and get their law degree and operate their own office. And neither of them seems to be driving the other out of business. This is also something that's very common if there's some possibility for replication of production processes. That is, if you can take what you're doing in part of your production and then exactly replicate that, then that would tend to lead toward constant returns to scale. For example, if I build a factory and I can build a second factory that will do exactly the same thing, then the average costs are going to be exactly the same whether I produce half as much or twice as much. So we end up with constant returns to scale in that case as well. Diseconomies of scale happens whenever a larger quantity is associated with a higher average total cost. In this case, small firms are going to be who's more competitive. Right. Some examples where we see that might be barbers or family doctors. Right. Very rarely do you see dozens of barbers working in the same barbershop. Very rarely do you see dozens upon dozens of family doctors operating out of the same doctor's office. It's normally relatively small, maybe a small handful of people. Right. Now typically this might happen if, say, paper cost is very high. Now paper cost here is something of a metaphor, but it's a case where you have individual clients, each with slightly individualized needs, so keeping records of each individual client is important. This is true for barbers, it ends up. While they don't keep paper records, I can go into my barber and say, oh, give me my normal haircut, take off about an inch, and he knows exactly what I want. Right? So individually, I am a slightly different person than, say, the person that comes in after me or came in before me. Right, so this is a case where trying to operate on a really large scale just isn't going to work. This also tends to be the case if location matters a lot. We can, after all, produce all of our cars in one small area and then ship them across the country. Right, that's not a problem. But it is a problem to try to ship haircuts across the country. It's not clear that this is in any way possible. That being the case, it's going to tend to be the case we see diseconomies of scale for things like barbershops. Now full graph then for price taker, putting in all these various elements we've built up. One, we have here, the black line is the marginal cost. The blue line is the average variable cost. We dealt with those in the short run. The red line is our average total cost. It will tend actually to be U-shaped, very much like the average variable cost, will be somewhat higher, because it includes not just variable cost, but also fixed cost. Then we also have here our demand curve, or the price line, telling us what the going price happens to be at any moment. Now, points here that we can draw out about decision making. Right, one, the price, remember, is taken as given. So, as a price taker, I first look at that price, and then I read it across and say, well, how much should I produce? Where it crosses the marginal cost curve tells me the quantity that I should produce. Then I can think about, well, I know there's this exception if I'm below the shutdown point, so I should check the shutdown point to make sure that I'm at least above that. Then I can start thinking about the long run. Say, well, am I making a profit? Well, it ends up my price is above the break-even point, so yes, in this case I'm making a profit. Or it might be the price is below the break-even point, at which point I'm not making a profit. Or maybe it's at the break-even point, at which point the profit is zero. So these are things we can tell. This also gives us a prediction for where prices are going to move in the future. Remember, if we are profitable, that is, if the price is above the break-even point, more firms will enter. That will drive prices down toward the break-even point. If we're not profitable, say we're taking losses, prices below the break-even point, it's going to tend over time to rise to that break-even point as firms exit. Finally, we can also tell how big our firm is going to be in the long run. So in this case, we know what's going to happen is that right now the price is above the break-even point, which is going to draw new firms in. But as new firms come in, the price is going to fall, leading each existing firm to decrease its quantity produced. So we'll end up in the long run with more firms out there, but each of them slightly smaller than they are right now. So drawing up conclusions we can get about price takers. An important point is that simply knowing the price and cost structure for a perfect competitor, or a price taker, can tell us a lot. First, it tells us how much to produce, or if we should produce at all. Knowing about the shutdown point answers that question, and marginal cost tells us how much to produce. We can tell whether or not we're profitable by comparing to that break-even point. We can also tell where prices are going to move in the long run, remembering that eventually prices do move toward that break-even point, as profits will tend toward zero. And finally, we can tell how large firms are going to be in the long run. With a little more information, we can actually take that a step further and say how many firms are going to be in the market in the long run if we know what demand looks like at the break-even point.